What I would like to talk to you about this morning is defect elimination. But before we look at defect elimination, let's understand the history of defects and understand where defect elimination's roots come from. The principle itself is certainly not new. For example, Panasonic in the late 90s launched a campaign based on the quest for zero defect. This was their company mission at the time, and they saw it as a market differentiator in terms of developing product. It was very much product quality focused, and really that is where defect elimination began its early start. Very closely related to Kaizen principles, helps us to look at products, services, whatever it may be, in such a way that we can eliminate defects and eliminate waste, which clearly we aren't interested in any form of business. So let's look at the potential causes of lost turnover within your business. Illustratively, I'll show you some examples: startups, reliability issues, low speeds, supply chain, raw materials, product changeovers. These would all be reasons for not selling product and therefore reasons for not attaining the turnover that we expect and desire. You'll notice quite clearly and illustratively that reliability is not the most significant issue. So how then can we include reliability as part of our asset management program? Similarly, I'll show you an example for a non-production related industry, so something more like infrastructure or somewhere where, product is not your primary focus. There you can see some examples: ineffective or incorrect capex, theft, project slippage, labor productivity, reaction times to problems. Again, reliability probably not the number one cause of losses to your turnover. So why then are we so focused on asset management? So what does asset management tell us? Having a look at the IAM's picture on the asset management journey, there we can see a number of activities which need to take place, ideally to achieve the most out of our physical assets. So it's creating value through good asset management. That's really what they're driving and what they're all about. Central to the asset management journey is the collective decision-making process. So how does that look for our return on investment? Let's understand the principles behind diminishing returns. In your typical asset management project, you're going to take a continuous improvement approach, and you're going to essentially implement over time various little improvements, small improvements that are going to add value to your bottom line in a very formalistic, very risk-managed approach, and will be sustainable over time. What we're really looking for is these sort of approaches. We want something that we can implement that's going to give us sustainable change in our performance. The returns our managers are looking for are more bang for their buck. So for every rand or dollar that they spend, they want to see the best possible earned benefit. And this is what they're expecting to see. In reality, slightly different picture, in that entropy will almost always set in and all the returns will tend towards zero over time. So what does diminishing returns tell us? It says we're going to have these quick wins, which are part and parcel of any project. We need to plan for them, we need to prepare for them. And we know that after a certain period of time, whatever that time might be, the returns that we achieve for the effort that we're applying are going to become less and less. If we were to superimpose a project process on top of that, we're typically going to prepare and plan something. We will implement the activities, whatever they might be, and hopefully institutionalize those after the fact to make them part of the normal day-to-day business. That way we are ensuring that our returns are relatively well sustained. So what we are seeing is two very distinctively different approaches. The first is a low formality, higher risk approach where we are identifying quick wins, high achievement opportunities that look at the entire business and not just the specific asset. The second is looking at very formalistic approach, something where we are analytical and we look at individual elements. They will both have different outcomes, and there is space for each of them, and there is certainly requirement for each of them. If you look at some of the popular models for asset management, I'm particularly using the uptime elements here from Reliability Web, you'll notice that there are a number of activities that are part and parcel of any asset management thinking, methodology, or approach to business. Items in orange are going to help us to make sure that reliability is achieved. We've got items in the green there to make sure that the condition of our assets is maintained and that our asset base is able to support the stable requirement of our production or of our demand for our products. Work execution management, making sure all our people are productive, and leadership for reliability, putting those corporate processes in place to prevent the entropy, to prevent the degradation of what we've built so hard to implement. Where does defect elimination fit into this picture? What is it going to help us in achieving, and how is it going to support our asset management program? Let's first understand what assets are and understand what the role of the asset management program should be. According to the Institute of Asset Management and ISO, assets are defined as an item or thing or entity that has potential or actual value to an organization. This would include physical assets as well as anything else we need in order to attain the value that we expect and that the market is expecting us to deliver. ISO 55000 further defines asset management as the coordinated activities of an organization to realize value from its assets. So how does defect elimination fit into this bigger picture? Well, defects erode value in the business, and value is an asset. In eliminating defects, we can realize the most value from our assets. Defect elimination should be applied holistically and at a high level to understand all the potential causes of losses in a specific product, asset, or service. Where it differs from the likes of RCM, FMICA, or any of the other methodologies we use is that those are very much focused on specific assets, on specific operating conditions. Our defects can come from a number of different places: people, equipment, environment, etc., etc. And all of these should be analyzed in order to find the causes of losses in the production process. Important to understand that your defect elimination can be used very effectively to finance the implementation of your asset management program and realizing real gains in such a way that they are able to generate direct and immediate income through increased product turnover, increased sales turnover, or whatever the unit of business is that is important for your specific function.